Today we are talking to Ted Seides, the author of So You Want to Start a Hedge Fund, Lessons for Managers and Allocators. Welcome to Rodera, and we're delighted to have your time, and we're looking forward to hearing your comments about the book.
Thanks, Manish.
Thank you. And give us a little bit of context that what hedge funds are and how the hedge fund industry has become, or how large it has grown over the years, and who are the key players, and then we can go further in the book.
Sure. Well, the hedge funds industry started as a boutique industry probably as early as the 1970s, and started as a mechanism really for investors or wealthy individuals to preserve capital. So very different from, say, owning the equity markets in an attempt to generate wealth, but a strategy is really strategy seeking to take advantage of inefficiencies, mostly in marketable securities, that would be relatively uncorrelated to the equity markets, but potentially generate the same types of returns over time. And from those early beginnings, and a number of the initial strategies were quite successful, those wealthy individuals sat on boards of endowments and foundations, and probably the early 90s, endowments and foundations started adopting hedge fund strategies. And as an industry, I think if there was an inflection point, it was really when my first boss in the business, David Swensen, wrote his seminal work, Pioneering Portfolio Management, in around 2000. Maybe it was 1998, 99, something like that. And he described what people didn't know a lot about at the time, which was the success Yale had had investing and the thought process, investment philosophy, and some of the strategies they pursued. And within that, one of the categories that Yale pursued was what they call absolute return strategies, effectively hedge funds. After that, and you went through a period of 2000 to 2002, where the equity markets had a difficult time, but because there were pockets of places to perform, hedge funds actually did quite well. Institutions really started adopting hedge funds as part of their asset allocation. And that accelerated all the way through the noughts, even through the financial crisis. And today, you have a very different industry. It's quite mature. It's an institutional industry. There's something like $2.5 or $3 trillion invested in hedge funds. And now the industry is at a different place in its growth trajectory as an industry. It's mature. There's some slow growth in aggregate, but that growth is happening in certain ways, and you're really evolving from a place where everyone is growing to some concentration and market share capture within the industry. So that's a little bit of a landscape about hedge funds and where we are today.
What is the current size of the hedge fund industry, and generally how many hedge fund managers are there who manage at least 10 million or more?
The industry itself, I think the reports are, I don't know the exact numbers, call it $2.5 to $3 trillion in total invested assets. And you'll hear that there are 8,000 hedge funds or so, but it's actually a very concentrated industry. So something on the order of only 300 of those 8,000 hedge funds manage north of $1 billion, and they constitute something like 60 or 70% of all invested assets in hedge funds. So just less than 5% of the total managers really command all the assets.
And in your book, you go ahead, you kind of start off with the lessons for managers and allocators. And what are those lessons?
Well, there are a lot. The book itself is really a set of lessons applied to managers that aren't in that mix of the largest 300. And the reason that I did that, I've really spent the 20 years of my investing career focused on earlier stage managers and investments and research in them. And what I found over time is that there really isn't an ecosystem for hedge fund entrepreneurship. And what I mean by that is in the venture capital industry, you have a series of venture capitalists who have a vested interest in helping startups develop as businesses. And you have a number of serial entrepreneurs. So you'll have someone who's built a successful business and then failed and then done it again. And so that ecosystem understands a lot of basic lessons in how to get a company on the path of success. In contrast, in the hedge fund industry, there really aren't serial entrepreneurs. If someone starts a fund for the first time, there's no reason for them to start another one if they're successful. And there are very, very few, and we probably know more than a half a dozen or a dozen entities that have had any real experience repeatedly in the startup phase of investing. And so what I found was that I had acquired kind of a body of knowledge of some basic lessons that many managers could benefit from, because every time someone new goes to start a company, they're doing it for the first time in the hedge fund industry. And I'd meet a lot of people one-on-one and try to share some of those lessons, but the amount I could share in, let's say, an hour conversation was limited. And I certainly thought I could reach a lot more of the industry to make it better by just writing down my thoughts and sharing it. So that really was the genesis of the book.
Mm-hmm, mm-hmm, mm-hmm. So maybe we can go a little bit more into the details, as the book title suggests. So you want to start a hedge fund. So what involves in starting a hedge fund? Attracting capital would be one, I guess. Attracting talent or having strategies and organizing your team. All those things would matter, I guess. But if you could explain to our readers what entails in getting a hedge fund off the ground.
Yeah.
And keeping it off the ground.
Well, right, that's exactly right. And I think, to be fair, I think this book is focused more on the latter question. Actually getting a hedge fund started. A lot of people say there are low barriers for entry to start a hedge fund, but there are high barriers for entry to stay in business. Actually getting it started really is a process that is somewhat commoditized. An individual who wants to start a fund speaks to lawyers. They create legal documents and legal entities that creates the fund. They then talk to the Wall Street community, in particular the prime brokerage operations, that kind of help them set up how their balance sheet will work and try to introduce them to some clients. They have to put a team together, get office space, put a plant in the office, all those types of things. The book focuses on some of the more subtle aspects of it. So in the concept of attracting capital, what I tried to do in the book was share with potential managers the thought process of allocators when they're looking at newer funds. And some of those things seem like common sense, I think, but really aren't common practice. And the biggest lesson in that area, I think if there's a broad lesson, is the notion that a manager should apply their intellectual horsepower to their business, or in this case, the process of raising capital, in the same way that they will in analyzing companies. But surprisingly, that often doesn't happen. So some examples of that are the importance of understanding how you're approaching a prospect and the signaling effects that are embedded in that. So an allocator, if you think about the seat that I sat in for many years, every day you come to the office and people want to meet with you. And many, many more people would like to meet with you than you have time to take meetings. So there's a filtering mechanism that allocators have to go through. And some of those filtering mechanisms include, how does that prospect actually get in front of them? So who made the introduction? And how did they present themselves when they, even in their written materials? Are there a silly email with typos or a professionally done presentation? And what does their pedigree look like? Really basic stuff. And where are there places they've worked that are attractive and known to that particular allocator? And those are steps that really aren't that hard to put together, and yet many managers don't really appreciate that allocators have a filtering mechanism. And as soon as they pick up the phone or they're going to type an email, they're sending signals, and if any one of those signals is negative, they're going to get turned away. That process then continues. If you're able to get your foot in the door, the classic kind of Malcolm Gladwell blink, what happens in that first moment? And how prepared is the person to make a great first impression? And then over the course, and that first impression will be an instinctive impression, and then of course usually goes over an hour and a half meeting. Now, how prepared are they in understanding the context that the allocator is paying attention to? Who else has the allocator been in front of? What types of strategies might that allocator be interested in? All sorts of things that help a manager have a productive first meeting. And then the process continues on and on through multiple meetings, through an assessment of operations, all of which are signals to that prospective investor of the quality of this one particular fund compared to the hundreds of funds that they might be meeting with or competitors to receiving that capital. And so using some examples, I try to lay out the simple lesson that each signal that a manager sends to an allocator is important. And if they trip up anywhere along the way, they're likely to get switched off and not be able to win over that particular investor. And I think that's the kind of core message in the section on attracting capital.
So apply the same rigor and same intelligence that you would as an investment or stock picker or investment strategy operator in finding or attracting capital as well.
Correct.
There's a nice, interesting chapter there, which is right after that, and that is about the focusing on in the attracting capital. There's a classic chicken and egg problem that everybody wants to be a second or third investor after you got the first investment, and then how do these funds go about breaking it?
Right. Yeah. And I don't think there's an easy answer to that. More often than not, when a fund breaks it, there's really one of two routes. The first route is that they're somehow already known to a significant allocator. So they may have worked at a prior firm where there were significant investors and had some interaction with those investors that end up being the kind of anchor for a new fund. The other route is sort of how the ecosystem works, and that is that there are different ways of breaking that chicken and egg problem across effectively giving away a better deal to incent an allocator to be an early investor. So that might be from the seeding business, and there are probably half a dozen firms, including my former firm, that are active in that business, where they'll effectively back in a venture capital-like way and share some economics in the future business in exchange for a substantial amount of capital to help a fund get off the ground. And there are other mechanisms called like the founder share class, which is effectively the same thing as a seeding. You're trying to get a critical mass of capital up front, with the difference that in a founder share class, the manager will offer a significant discount to a group of investors where the commitment isn't quite as high on any one, but collectively they get the manager where they want to go. And then the last method is that some people just decide to get started. So perhaps they have enough personal and friends and family capital that they can pay the bills for a few years, and they just get going. And through whether it's the prime brokerage network or other relationships in the business, usually they start talking to high net worth individuals and trying to get small checks, $1 million, $2 million here and there, and over time grow the business to the point where they have a track record and can attract some of the institutional larger pools of capital. So those are the different ways that funds often go through that process.
No, very helpful. Where are the choke points, or where most hedge funds don't even pass 3-year time frame or 5-year time frame? Some short time frame is a pretty big hurdle. What do you think that the managers can look out for in order to avoid those choke point problems?
It's a very competitive industry with very, very high expectations based on the clients, and so to some extent there's a choke point almost every day of the week, and that creates an unhealthy, in my opinion, short-termism that pervades the industry. That said, knowing that often is the structure of these vehicles, one of the ways a managers can mitigate those choke points is by playing for the long term at the very beginning. And so perhaps if they have the wherewithal to do so, some managers only accept capital on a longer duration terms. Now that can be very tough to do because it makes the chicken and egg problem even harder, because there's a much smaller subset of potential investors who are willing and able to lock up their capital for over time. But if a manager has the ability and wherewithal to be patient, to grow a business slowly, they may find that they have longer duration, effectively liabilities, which allows them to invest for the longer term and withstand some of the market volatility better than others. But without the ability to do that really up front, those choke points are they're ever present in the hedge fund industry, and they really don't go away.
Mm-hmm. Mm-hmm. The short-term focus of the industry is extremely stressful and it puts enormous pressure on the fund managers. Sometimes the managers are evaluated based on a daily performance, forget about the weekly or monthly performance. And that gets very difficult. You mentioned in the chapter team that you have a very nice title there, the Two-Headed Portfolio Manager Monster. Can you describe that a little bit more?
Yeah. One of the common mistakes that happens, and this is really in the startup hedge fund area, is that you'll have two people who maybe, let's just say they're in their mid-30s, and for as many as 10 years have been friends in the industry. They might have worked for the peer hedge funds, shared ideas together, done research together, get along really well. Their wives might be best friends, whatever the case may be. And they both come to a point in their careers where they know they had wanted to start their own shop, and they say, great, let's do it together. And that's fine. And it's probably a good thing to have, more than one kind of senior level horsepower, because there's a lot to do when you're launching a hedge fund. But the mistake that you see commonly made is that without understanding some of the past and the mistakes others have made, they decide to share portfolio manager responsibilities. And if you were to look at the landscape of the hedge fund industry today, what you would find is almost none of those 300 or more, almost none of the successful hedge funds have equal co-portfolio managers. I know of no more than 2 or 3 in the entire industry. And if nothing else, you could look at that and say that Darwin has adversely selected that structure to survive. So even though people may think that's a great default, and there are a lot of reasons why theirs will be different than others, we know through history that that structure doesn't work. And there's all kinds of reasons that may happen. It might be the personalities of the individuals. It may be the challenges in making rapid decisions in times of stress. But what we know is that species is nearly extinct. And so if someone's starting, they're much better off coming up with a different portfolio manager structure. One of the phrases I like to say is, 2 heads are better than 1, as long as one is slightly larger than the other.
So clear division of responsibility is very important, and also having separation of duties may be even better.
Correct.
Yeah. Of course, once the team is in place, the process, so the investment process becomes important. What are the building blocks of process that are successful, that successful fund managers employ, or that you have found are common practices?
Yeah. Process is very important in generating repeatable success in the investment world. And I think the general categories of an investment process start with having a core investment philosophy and really answering the question, why does a particular strategy work? And surprisingly few funds have that as a key part of their thought process day in and day out. Why is what they do work? Why does the inefficiency they're trying to exploit exist? Because if they can answer that question, they can be more nimble when things change. So starting with investment philosophy, and then you move into the strategy. And the components of the strategy usually have to do with the sourcing mechanism for generating ideas, the research process that goes into fully vetting an idea, the decision-making process between the portfolio manager and analysts, the risk management process to help determine sizing of positions, and then the entry and exit of trades and position sizing process. So those are some of the aspects of the investment process. Then alongside of that, you'll have the aspects or components of the operations. So the accounting process, the legal and compliance process, and making sure that each aspect of the business is sort of codified in a way that can be repeatable. And that process, what the process is, can be very, very different for different firms. But those that succeed have a defined process in place. It may change over time. It's usually ever evolving. But it's not just, hey, show up and we'll find a few names that we like and names to short that we don't like.
Mm-hmm. And how forgiving investors are if there is a style drift, or are they looking for a certain kind of adherence to style as long as you're delivering performance, or how industry or investors react to that?
It's a really tough tautology for investors and hedge funds. So the notion of hedge funds is that managers can have flexibility, they can go across strategies, they can take risk in ways that, say, the traditional mutual funds really didn't. And those are all good things. But the challenge is the more flexibility that a manager takes, the harder it is for their investors to calibrate expectations. And so what happens over time is actually designing in flexibility is not an easy thing to do. And if a manager shifts from, say, a defined strategy to something, maybe an area that they think is more ripe for returns, the investors can have an adverse reaction, even if it ends up being a sensible shift. So to give you probably the most public example of that right now, in the movie The Big Short, that's in the picture, it's in the theaters right now, Michael Burry of Scion Capital had been a fantastically well-performing equity long-short fund. And he was one of the earliest discoverers of and creators of structured credit to short subprime mortgages, and ended up making an incredible amount of money. But it took a couple of years, and he was bleeding losses in the period of time, and his investors absolutely lost patience because they saw him only as a long-short equity manager. And so when I talk about strategy in the book, I talk about both the concept of having flexibility and the concept of staying focused on a particular niche or investment strategy, with the commonality that the most important thing a manager can do when they're starting is decide what game they want to play for the long term, and then communicate that effectively, both the strategy and the expectations around that. And that way, if they have a strategy that they want to be flexible and they communicate it well when they're trying to raise money, the investors that will gravitate to them will be the ones that embrace that flexibility. Whereas if they start talking about a narrow strategy and they have investors that buy into that, but then later they want to engender more flexibility in the strategy, it can be very, very difficult to shift the investors from one strategy to another. And when that happens, the cries of style drift that lead to redemptions from funds really come after a period of negative performance. So manager shifts strategy. If it works, they might get a reprieve from their investors. They might look brilliant. If it doesn't work, they're probably going to get fired. Even if they see an investment opportunity outside of their core strategy, if they choose not to pursue it, and as a result if they were right, and as a result their returns aren't as good, at least their clients can say, well, you're doing the thing you told me you were doing. Whereas if they stick to their strategy and they perform well, so maybe they were wrong about the shift in strategy and just generating great returns, then the investors love them. So it's very, very hard for a manager to actually create more flexibility as time goes on in their mandate, because of the difficulty in calibrating expectations with their investors.
It's a delicate dance between a group of investors and a fund manager with his team of researchers and a strategy. How important is disclosure of investment performance on a very frequent manner, like monthly, weekly, or quarterly? And how does what managers can do to prepare investors so that they don't get slave to almost short-term performance?
Yeah, it's a really systemic problem, I think, in the hedge fund industry. Managers, the reporting frequency of managers has shortened over the years. And because it's hard to define benchmarks in the hedge fund world, the focus on performance is tantamount. And what I mean by that is, say, in the traditional mutual fund world, if someone's investing in large cap equities, they can report their performance and they can report the S&P 500 index, and their investors have a sense of if they're outperforming or underperforming. And so there's a reflective nature that I think doesn't benefit anyone, where managers have been asked to report more frequently. And as a result of that, the investors ask more questions about relatively short-term performance drivers. And then that causes the managers to think that their investors are focused on the short term, so they get more and more focused on short-term results. And investing is hard enough to succeed in the long term, and it's particularly difficult if a manager is faced with having to continuously perform in the short term. And this isn't something that is a particular issue with just hedge funds, and it's true across all of asset management, where you could look at the Dalbar studies of mutual funds, and through history, the returns generated by investors in mutual funds are much, much worse, or the dollars earned are much, much worse than the funds themselves, or if the investors had just kept their money in the funds all along, they would do quite a bit better. But investors across all stripes have a tendency in aggregate to sort of sell after a tough period of performance and then chase returns when they're entering. And I think that is equally true of hedge funds. Now, one of the things that's interesting about it, however, is that because hedge funds offer less liquidity than a lot of traditional vehicles like mutual funds, the investors have fewer opportunities to get in their own way effectively. And the experience of 2008 and 2009 was a great example of that, and particularly in the credit markets, where the credit markets froze effectively after the Lehman bankruptcy. And at the end of 2008, it was so difficult to price many of the instruments held by credit-related hedge funds that a lot of them suspended redemptions. Now, at the time, their investors were very, very upset because they felt like they wanted their money. But if you just rolled forward 1 year, what was ironic is the people that wanted their money so desperately were actually protected from themselves because they were forced to hold assets that then subsequently rallied quite strongly in 2009. And so hedge funds as a structural vehicle, even though performance is focused too short term, and I think it is, and it's very, very hard to change that, the investors don't have as much opportunity to come out. And that's a good thing for the investors. The other piece that sort of is probably misunderstood in the public is that the volatility of hedge funds is quite a bit less than the volatility of equity markets. And so as a result of that, even within the bounds of the liquidity structure, hedge fund investors are less likely to be shaken out of their investments as frequently because they don't experience as many sort of periods of significant negative performance. And so there are a number of structural aspects of hedge funds that make them at least superior to traditional asset vehicles in terms of the ability of the investors to be longer term. That said, I do think that investors in hedge funds are sort of more short term than they were, a decade or two ago.
Mm-hmm, mm-hmm. Well, so far we've talked about the managers and the people who are operating or starting a fund, but what about on the investment side? What kind of investors should look for or should be looking to invest in a startup hedge funds, and how they can influence, as you say rightly in the book, how they can influence also the some of the investment strategies or the potential outcomes?
Sure. It's funny, a lot of the lessons that I write about in the book that are really written to talk to both managers and allocators, because if there's a strategy like we talked about, the two-headed portfolio monster, well, that ends up being a bad structure for a manager to put in place. But it's also something that an allocator can look at and say, well, those types of funds are unlikely to succeed, so why don't I just pass on that opportunity? But more broadly, it's an interesting crossroads at this mature stage of the hedge fund industry because of the concentration we talked about, most of the investors in hedge funds are accustomed to investing in large funds, and that's just how the math works. But what happens is the patterns of success in large funds are very, very different from those in smaller funds. So the allocators who now, as some of the larger funds leaders are retiring, they're looking for smaller investments or smaller sized funds to make their investments into. they need a little bit of the knowledge of what succeeds as well. And so there are a few things that I talk about in the book as signaling effects that are very different. And so I'll give my favorite example, which is team turnover. So generally speaking, in large funds, if an important member of the investment team leaves, that's rarely a positive signal. Large funds can pay their people as much as they want. They can offer all kinds of interesting incentives for people to stay. But if someone important leaves, that's usually not a good thing. And the investors in these funds have become accustomed to seeing that as a negative signal. So the concept or the pattern recognition in large funds is that team turnover is a bad thing. Well, it turns out that if someone's starting a fund for the first time, usually when they start, they're resource constrained. And so they'll try to acquire the best team they can. But far more often than not, if they have a little bit of success, if their business grows a little bit, if their revenue base increases, they may have an opportunity to upgrade their team, or they may have made a hiring mistake in the early going. And oftentimes, particularly when it's a small team, if someone who's the leader of that organization decides to make a change, that ends up being very positive for the organization and for investment returns. Now, at the same time, allocators are still accustomed to thinking that that's a bad thing. And so the allocators don't quite appreciate that in smaller firms, it's much more balanced, right? Sometimes the turnover might not be a good thing for the organization, but oftentimes it is. And so to be a little bit more level-headed of the assessment of what happens when there's team turnover is one example of how allocators need to think a little bit differently about investing in smaller funds. And then there are some things that allocators can do that I think is more broad, but certainly applies to smaller funds. And so one is understanding, it talks about it a little bit with performance, but understanding the reflexivity of the relationship between a manager and an allocator. The allocator's job is to stay in touch with the manager, to make sure they can continue to confirm and reconfirm their investment thesis. And in doing so, they will ask a number of questions of the manager. And those questions can influence the manager's beliefs about what their investors think and really care about. And so that's something, again, just the allocators need to have in the back of their minds, that their interactions and their relationships actually can influence the outcomes that they have. And similarly, on the other side, most allocators report. So they report to an investment committee. They have clients, if it's an intermediary fund of funds or a consultant. And so hedge funds, like any other vehicle, are not going to make money all the time. And they're a little bit less understood the further you get removed. So the hedge fund manager understands the companies or strategies they're investing in. The allocator is trying to understand some of that, and they understand deeply the manager and the organization. Well, the governance board is looking to their investment team, who is then investing in the manager and the organization, who is then investing in the companies. And each time you get 1 degree further removed, it's harder and harder to assess anything but the outcome instead of the process. So when an allocator is investing in hedge funds, and particularly in smaller hedge funds, they need to prepare their governance board that it might not look the same as their larger hedge fund investments. So each individual smaller fund tends to be less diversified than a larger fund that might have a lot of teams under the same umbrella, and they need to prepare their governance board or body that everything might not be as smooth, it might not look the same as it was. And that's just in the same way, we talked earlier about a manager trying to gain flexibility. The communication aspect of it sort of pervades the process, almost no matter where you sit. And those are some of the lessons for allocators I discuss in the book.
How did you get interested in this business, as you have experience in this industry? And if you would explain a little bit about yourself, and how did you end up writing a book?
Sure. Well, I was a Yale undergraduate and took David Swensen's course as a junior. And it was one of the classes it was on portfolio theory. It was one of the classes that I enjoyed the most. And he had mentioned that they hire one person a year for their investment office. And a year later, that led to my joining David and the team at Yale right after graduating, and that was really my introduction into investing, institutional investing. And I thought I would stay for a year or two and go to business school. I had so much fun, I ended up staying for 5 and eventually left. And when I came out, it was around the time when David had written his book. And so I had an obscure job that no one had ever heard of before, all the way through when I went to business school. And I spent a few years directly investing, and the next thing I knew, everybody knew who I was because of where I had worked a few years before. And I had an opportunity to sort of turn that into an entrepreneurial venture, and decided to focus on the hedge fund area only because it's such a heterogeneous area that encompassed lots and lots of the different asset class exposures that I saw at Yale. And I thought that would be a fun way to focus, because you'd have the combination of focus in a particular area, but then a great diversity of ideas. And so that was very attractive to me. And over the years, you get older, you sort of learn to appreciate who you are, and that you're not everything to everyone. But some of the things that most resonated with me investing in other people come from my parents. And my father is a psychiatrist, and my mother is a teacher. And so the notion of really analyzing people and wanting to bet on people and help them out is something that resonates with me and the partnerships I've had with terrific money managers. And maybe the teaching side is what turned into the book. I had all these conversations, and they felt like they were the same conversations over and over for me. But whenever I had them with aspiring managers, and increasingly more recently in the last few years, allocators, people seemed kind of wide-eyed at these lessons. And so rather than just kind of hold them for myself, I thought it would be wonderful to have an opportunity to put them down on paper and share it with as many people as I could.
Mm-hmm. And we are all glad that you did, because it certainly propagates the message and the knowledge across the whole wider audience there. What do you do currently?
I left my former firm in the fall and spent some time finishing, a fair amount of time, more than I thought, finishing up the book. And I'm currently, I've currently hung a shingle. A few projects came my way to really help some friends out in the industry of a range of activities. There's a mid-sized hedge fund looking for some help on strategic marketing, a talent development organization called the Imprint Group that I've worked with over time and have formalized a little bit more. And I think that's probably a temporary stop for me as I pay attention to what's happening in the industry and what pools of capital are good, stable, long-term pools of capital. And I suspect at some point in time I'll dive back into the investing side.
Are you working on any other book or any other projects that we might see in the book format going forward?
I don't, not yet. This one took a while and was really, in some sense, 15, 20 years of knowledge into one book. I think I'd always wanted to write a book, and maybe I will again one day when I feel like I have something to share worthwhile. But I do a fair amount of thought piece writing. Most of it ends up on the CFA Institute's Enterprising Investor website, where I have a blog. They're going to be excerpting some of the sections of the book, and I'm currently thinking about and working on a piece of just about the current investment environment and how confusing it is to everyone, and trying to help make some sense of that. But no substantial projects like this anytime soon, I think.
Well, thank you very much for your time and your comments, and I think our readers and listeners will be delighted to finally dive into the book and get more insights about the hedge fund startups and how the industry operates from the managers and allocators perspective.
My pleasure. Thanks for taking the time, Anish.
Thank you.